Imagine working hard every day, paying bills, doing your best, but still feeling like getting ahead financially is harder than it should be. A lot of times it's not your income, it's the myths you've been told about investing. Many people avoid investing because of misconceptions about the stock market. Those myths create unnecessary barriers and keep people from building long-term wealth. So let's debunk the most common myths and replace them with the reality behind successful investing. Let's start with the first myth. The stock market is only for rich people. That's one of the biggest reasons people never begin. But here's the reality. You can start with as little as $5 to $50 using fractional shares and low-cost ETFs. A lot of people think you need thousands of dollars, but modern investing platforms have made access much easier. Fractional shares let you own pieces of expensive stocks, and ETFs give you instant diversification with a small amount of money. Myth number two, it's too risky, I could lose everything. That fear of a total wipeout keeps many people out of the market completely. The reality is diversified ETFs and long-term investing are among the safest ways to grow wealth. Risk is real, but it can be managed through proper diversification and a long enough time horizon. Next myth, I don't know enough to invest. A lot of people believe investing requires expert knowledge. But the reality is, simple automated investment plans and index ETFs make investing easy for almost anyone. You don't need to be a financial expert. Automated platforms and broad market index ETFs do much of the heavy lifting, making wealth building accessible. Myth, I'll wait for the perfect time to start. This is one of the most common traps. Fear of buying at the wrong time keeps people frozen. Reality, time in the market beats timing the market. Starting early matters more. Historical results consistently show that staying invested over time tends to work better than trying to predict the market. The best time to start was yesterday, but the second best time is today. Myth, only professionals make money. People assume Wall Street always wins and everyday investors can't compete. Reality, ordinary investors who stay consistent often outperform active traders and even many professionals. Simple buy and hold strategies often beat complex trading approaches. Myth, investing is like gambling. Some people see the stock market as pure luck. The reality is that gambling is chance. Investing is long-term ownership of real companies with real earnings. When you invest, you're buying pieces of businesses that produce value over time. Another myth is, I don't have enough time to manage it. People think investing requires daily watching and constant attention. Reality, long-term portfolios require very little maintenance, sometimes only a few times per year. A lot of investing can be automated from contributions to rebalancing. A set-it-and-forget-it strategy often works remarkably well. Check your portfolio quarterly, rebalance annually, and let compounding do the work. Myth, I'll invest after I'm debt-free. Many people postpone investing for years, waiting for perfect conditions, but the reality is you can invest while managing debt. In fact, waiting too long reduces long-term growth. The best strategy is to balance both. Pay off high-interest debt while still contributing to retirement accounts so you don't miss years of compounding. Finally, the last two myths. The first myth, market crashes mean I'll lose my money forever. Reality, markets have always recovered and reached new highs over time. The second myth is it's too complicated. Reality, you can build wealth with a simple portfolio of 2 to 3 ETFs. Every major downturn in history has been followed by recovery and growth. Patient investors who stayed the course were rewarded. And simplicity wins. A basic diversified ETF portfolio is often all you need. Now we're moving from theory to proof because talk is cheap. So let's use a real example. Here we're looking at S&P 500 returns from 2015 to 2025 year to date. This decade shows how ordinary investors can turn modest investments into meaningful wealth just by staying invested. This is where the numbers get powerful. If you invested $100 at the start of 2015, it grew to about $379 by the end of 2025. That's a 279% total return, including dividends reinvested, about 13.4% annual average. And even after inflation, you still see about 177% real return. The message is simple. Patient, consistent investing has historically outpaced inflation and traditional savings. Here's the S&P 500 year-by-year performance from 2015 to 2025. Notice something important. Not every year is positive. You see down years like 2018 and 2022, but you also see strong rebound years like 2019, 2021, 2023, and 2024. These returns include price appreciation, reinvested dividends, and compounding. This chart brings the story to life. Even with temporary setbacks, especially in 2018 and 2022, the trajectory is still upward over time. The market's long-term pattern has been resilience and growth, and it tends to reward investors who stay the course instead of panic selling. Here's why this matters to you personally. Reason number one is outperforming alternatives. Historically, stock market returns beat inflation, savings accounts, and bonds over long periods. Reason number two is dividend power. Reinvested dividends can significantly boost long-term results. And three, compounding growth. The longer you stay invested, the more your gains start generating additional gains. Let's scale it up so it feels real. If $100 becomes $379, then $1,000 becomes about $3,790, $10,000 becomes about $37,900. And the reminder here is critical. Inflation-adjusted growth means your buying power increases, not just the number in your account. This is the conclusion in plain terms. The S&P 500's 13.4% average annual return over the decade crushes the typical savings account rate of around 0.5%. Investing is also a proven way to protect against inflation over time. And most importantly, time is your ally. The best time to start was yesterday, but the second best time is today. Let's recap the full list quickly because these are the myths that keep people on the sidelines. 1. Only rich people can invest. The truth is you can start small, even around $5. 2. Too risky. However, diversification and long-term investing reduce risk. 3. Don't know enough, but basics plus simple tools are enough. 4. Only pros win, but many pros don't beat index funds after fees. 5. Wait for perfect time, yet time in the market beats timing. 6. Investing is gambling. Investing is actually owning productive companies. 7. No time but passive investing and automation take minutes. 8. Invest after becoming debt-free. Balance both so you don't lose compounding years. 9. Crashes mean permanent loss. However, markets historically recover. 10. Must pick winning stocks. Diversification beats stock picking for most people. And here's the final message. The biggest risk isn't losing money in the market, it's missing out on decades of compound growth because myths kept you out. Start small, stay consistent, and let time work for you.